Okay, we are live and ready to go. Hopefully we'll have people starting to join us in the room, which we do, which is fantastic. Welcome everybody. Thanks for coming along to the webinar this morning, wherever you're joining us from. I know we've got some people who are regular attendees to our webinar, so welcome back to you folk. Thanks for coming along again. Just as people are joining us, we're just experimenting with this new format of the Xact-Mini webinars. Things are pretty hectic for everyone, and we've got a lot of, I guess there's a lot of things for people to learn and content to get through. So we're trying out this new format of the Xact-Mini webinar, which is just really short, sharp, bite-sized pieces of information, and we'll focus on one particular topic each time. But today, to kick that off, we have Jarvis joining us. Say good day, Jarvis.
Hey guys, thanks for having us.
No problem, thank you. And Josh is one of our partners at Xact. I'm going to share my screen now, and we're going to jump straight in so that we can get things moving. Today we're going to talk through SBR, Small Business Restructuring, which is, as the title suggests, a pretty quick way to deal with accumulated debt. And Jarvis is going to take us all through that. Just a bit of housekeeping at the top. I assume you can see those slides, guys, yeah? Great. The agenda, we're going to go through SBR. What is it? Who it's designed for, how the process works, and because this is building and construction focused, and we all want to keep our licenses in this game and continue to trade, there's some implications or just some things to consider as well around licenses. So we're going to go through that, and we've got some case studies that we're going to talk through as well at the end, just to sort of try and bring that to life a bit more. We're going to send a recording out of the session after it's over today, so that should come out this afternoon. And questions, we usually in our webinars get you to drop the questions into the chat, and we answer them as we go. But I think with this one, just so that we can keep the content flowing and it's a shorter format, we might just get you to, even if you want to just write them down, you can put them into the chat as well if you like. We have the chat operating, but we're going to hold off until the very end to answer those questions. Hopefully we can answer as many of those as we go anyway, just with the presentation. We will though, and because this is I think this is a bit of a sensitive topic for people. When you're in financial distress, you might not want to publicly ask a question about it on a webinar format like this. You can ask that question to us anonymously, so just to the event, just to the panelists, rather than into the open room. Also though, and we'll put up a poll at the end, we're going to offer a one-on-one consult as well, so that you can talk to either Josh and the team at Xact or Jarvis from Reset. So we'll do that at the end as well. Just quickly about Xact, we do 3 core service areas. We do bookkeeping, which is all about getting accurate, timely data into your world and not having to do that yourself, getting building industry bookkeeping specialists to look after that for you. We do compliance, all the things you'd usually expect in terms of tax and structuring, asset protection, but again, from a building and construction perspective. And then finally, we have a CFO advisory service. So this is for businesses who are sort of starting to turn over 5-10 million and above. You really need to kind of level up from just having a bookkeeper. You need to start building out a finance team. And so we do that as an outsource model, rather than you having to hire in a finance professional yourself to help work on margins and better financial visibility. Today, Josh, as I said, is one of our partners at Xact. He runs one of our compliance divisions, knows everything there is to know about things like QBCC and home warranty. That's a bit of a superpower, but also, restructuring for getting the best possible tax outcome, both now and into the long, long future, because you do need to plan these things in advance, and has been quite involved in the journey that we've been on as a firm with SBR, this small business restructuring process. So welcome, Josh. And Jarvis, who is the best looking guy in the finance industry in Australia. Jarvis,
Beautiful from far, but far from beautiful, I'd say.
our very own Mark Wahlberg, is here today. He has an extensive history in the insolvency liquidation side of the finance sector, but was very early into the whole concept of SBR, and I think has done more of this work than anyone else in the country, which means he knows how this applies to the building sector, because the building sector has been the hardest hit. When we think about people who are carrying debt that probably is a bit of a leftover from COVID and those kind of scenarios. Jarvis, we're going to hand over to you now, mate, if you want to share your screen, and we'll kick off. Jarvis is going to take us through the main meat of the presentation, and then we're going to get through to these examples. We'll bring Josh in at that point as well. So over to you, Jarvis.
Okay. Hopefully that's screen sharing now. So yeah, small business restructuring does what it says on the tin. So just a quick overview. The light green there is what we're focusing on. That's construction, small business restructures. And so construction and hospitality basically equal all other industries for SBRs, and construction's always the number one sector for insolvency. I think pre-COVID, it was 1 in 5 insolvencies was a construction business. During COVID, it got to 1 in 4. And then through about 22, 23, it was 1 in 3, right? So every third insolvency was a construction business. So the good news is now we've got this option that can actually reduce ATO and other debts and save the business. Now, quick recap, why it matters, right? Who cares? Why do you want to hear from liquidator? You probably don't, but it's when you got ATO debt primarily that you can't pay. The ATO is a creditor in about 90% of SBRs, and 80% they're the major creditor, probably the only creditor. And the aim is to save the company and reduce that ATO and other debts down by about 70%. And then the balance of the 30%, you can pay it typically up to 2 years, or you might put the funds together to pay it as a lump sum in one go. The great news is I'm not running your business. Unlike any other insolvency, you are in full control throughout. I'm just sitting here dealing with the debt. That's what I like doing. I don't want to run a construction business, and you don't want a liquidator running your business. So fantastic. Now, the fee model is set by the law. You have to charge a fixed fee and then percentage in the plan when it's accepted. So we try to make it simple. Debt's less than 200 grand, 10 grand up front, including GST. If the debt's more than 200 grand, 16.5 grand up front, including GST. That can be a chunk for some people, so we can be flexible if need be. And then when your plan's accepted, there's about 20% of the plan payments is what we need to pay. So as a benchmark, you might pay the ATO 25%. Our 20% of that is 5%, and that's where we get to that 30% is what you pay typically when your SBR is accepted. Could be a little bit less, could be more, depending on your situation. Now, what matters is your eligibility. So your super's paid for all your staff. Director super can be included, which is not particularly well known. So if it's just the director's super, good stuff. You can throw it into the SBR alongside the ATO debt. All your ATO lodgements need to be in or be able to be brought up to date. And then there needs to be less than $1 million of unsecured debt. So car finance, equipment finance, and secured bank loans, they'll be out of it. But your unsecured loans, your ATO, payroll tax, if you've got it, suppliers, they're all, anything that's owed at the SBR start date is included. And so that's why a little bit of planning goes a long way, because naturally no one wants their supplies included. And it's not even if they're due or not, it's any debt, any invoice, even if it's due later in the month. So that's where picking a time in the month where you're in between supplier invoice cycles means that you're going to have the minimum impact. So I'm only going to be writing to the creditors. If the ATO is the only creditor, happy days. And the only thing there is it will hit your company credit report. And so there's some careful consideration there in preparation, because if someone's going to find out, you'd prefer to be the one to tell them. But naturally, you don't want someone to know that won't find out. So something we work through every time. Now, viability, right? So that's the sort of tick the boxes. The key for success. So director loan accounts, if you're not on the payroll, you're taking drawings or using the company credit card for your personal expenses, that creates a big problem, because the ATO goes, well, hold on a minute, you didn't pay our BAS debt over here, and then you took that money tax-free, so we missed out twice. So there's nothing I love more than hearing the director say, I'm on the payroll these days. Simple, but it works. Now, if you haven't been paying the ATO in the last 2 years, you better start now, because the ATO needs to see you're a genuine taxpayer. And if you're not paying, they either think you can't pay, so you're too cooked to even pay anything, or you won't pay, you're trying to avoid your tax obligations. Neither of those are going to put you in a good position to negotiate a haircut. And then the last thing is your business has got to be making money. So it's fine. You know, COVID smashed up a lot of construction businesses, fixed price contracts, etc. We'll have a look at a couple of examples. The thing is now, if we're going to save this business, it's you got to have brought it back, right? I spoke to someone the other day, NDIS business, losing 27 grand a month. What are we saving, right? The debt reduction, that's not changing that 27 a month. So that's with you, and that's with Xact. They've got that CFO advisory team, Josh. You work together, make sure that that bottom line of your profit and loss is a positive number, and then we're good to go. And then I just mentioned there, it's all unsecured creditors, right? So, you know, everyone wants just the ATO, but everyone that's an unsecured on the SBR start date is captured under the law. So quick overview, home warranty insurance and licenses are the two things here that in SBR impact. So Queensland went from the worst state to be a builder to the best with the SBR, a bit of a loophole, but the QBCC has been very pragmatic, and they've got no issue there with the SBR. We've done heaps, and they could see the benefit there in terms of being able to reduce the federal debt. It avoids subbies getting smashed up and home warranty insurance claims. So great. New South Wales and Vic, a little bit harder. The license, no worries. The home warranty insurance, because it's private insurers, a bit difficult. And we'll talk about what we need to do there, but basically you need to finalise your SBR. So you lose insurance for your new project. So ongoing projects, no worries, but you can't get an insurance for a new project until the SBR is over, you've paid it all out, and then you reapply, right? So that's where doing a 2-year payment arrangement isn't going to be very appealing if you can't take on new projects for 2 years. And that's where careful planning to make sure that the SBR works for you and the timing of it doesn't wreck your business, because that's the opposite of what we're trying to do. All the other states, they're pretty loose and haven't had any issues, right? So eastern states, all pretty good, but you have to look at the insurance in the southern states. Sorry, I did just say here. So yeah, I guess with the QBCC and the others, to avoid triggering any other rules, right, that will create problems for them, you need to make sure, your subbies are paid and you're completing the contracts. You can't just throw some unprofitable contract into your home warranty insurance and then hope that, that all gets cleaned up, because particularly in Queensland, you'll still be personally liable. It's still going to piss the building regulator off, right? So you got to.
They've been quite good, haven't they, Jarvis? QBCC has been quite supportive of the process.
Yeah, I haven't had a single issue.
They've been so surprisingly for the Queensland regulator, being very, very pragmatic, as you say, and just letting us get on with it. And later on, circling back, it's been quite a breath of fresh air from QBCC, actually.
That's right. Look, make it easy for them. They'll make it easy for you. If you got problems there and subbies are not getting paid or whatever, people are complaining about you, it creates other problems for them.
I think, in the context of a housing crisis and needing to keep as many builders in the game as we can, I think it's a good sort of policy setting from QBCC. And I think, like obviously, their ratios, the tests they're looking for, one of them, being net tangible assets, then this has a meaningful impact on
That's right. Yeah,
on that,
yeah.
on
So
that position. So
exactly, they just look at what happens when your ATO debt is shrunk down to a much
yeah.
smaller size and your balance sheet looks a lot better.
So
So let's rip
we're
in.
going to talk. Yeah, we'll talk through some examples. Just to helicopter just quickly.
Mm.
So the whole principle of SBR is that you negotiate an outcome for unsecured creditors, and ultimately, though, they all get dropped in the same bucket. And Jarvis understand that it's a 50% or more of those creditors have to agree. That's the
That's right.
arrangement. Yeah.
By value.
Yeah, that's right. So the majority of creditors by dollar value, usually the ATO is the major creditor, if not the only one. And so the ATO is important, and we speak to that because they're the decision maker. The good news is, at least over a year ago, they were saying yes 90% of the time plus. They say yes to us almost 90 or probably 96% of the time overall, but it's been 100% this year, right? So that's what we focus on. We look at it as if we were the ATO. Are the ATO going to say yes to this? And if they're not, well, we're not going to tell you a sweet story, because we've had 4 people that we've spoken to recently. They all said, oh, no, we're going to other firms, cheaper, whatever. They all got knocked back. Stupid.
Yeah.
That was their one shot, blown, because someone wanted to charge them, I don't know, 5-10 grand. For them, what do, right? Like that could be the end of their business, could be going bankrupt. So all over, a little bit of poor preparation and a cheap fee. So
yeah, and I think the preparation bit and the assessment of whether this is a viable option or not is obviously really critical in terms of what your success rate looks like.
yeah, exactly.
And it's where the collaboration comes in between firms like Xact and the work that we do with you, Jarvis, around trying to look at the best possible outcome for the client, but also to work together to make sure that we have all the information in front of us to make a really good call about whether it's going to be an option, and then how do we go about it from there. So it becomes a real kind of team sport.
Yeah, and we have to obviously work in concert with Jarvis, and we have on countless, probably nearly 10 SBRs now with the Jarvis, and we're about to go through 3 examples, but it's only worked by working in concert both sides, not just throwing it over the fence to Jarvis, but doing some really detailed planning. Sometimes this planning can take actually quite a few months before we even talk to Jarvis as well, because a big part of it is convincing Jarvis as a restructuring practitioner that the business is actually a viable business. There's no point doing all of this if Jarvis looks at it and goes, this is really, you've got bad history, you're not lodging your stuff on time, you've had a really bad record. Why should the creditors take a haircut, right?
Yeah. That's right. No, 100%.
Right.
And that's the problem where the accountants know where to be seen, because they go, oh, no, I just do the tax. Very difficult situation for the client, because I'll be going, hey, you got a 400 grand director loan. The accountant doesn't want to know about it. The client can't do their own accounting. So that's why you guys have the success and why you can help people with it. So why don't we talk about this one? So Josh,
I might do a quick intro. So all 3 of these, there's no surprise that all 3 examples will be residential construction sector. Residential has copped an absolute hiding, particularly fixed price contracts, which will be the theme throughout all of them. Because the main thing is those fixed price contracts took a long time to actually play out, and the debt accumulated, and it was an absolute killer through them. So this one sort of came to us. They're a relatively new client to Xact, and we sort of worked through it. Could see that they had viable business moving forward, but we did have an anchor of the prior years, the COVID time. We thought, look, this one's a good example to talk to Jarvis. The key thing in this, and Jarvis mentioned this before, is this client really did sort their finances out pre-going into SBR, because it does impact your credit file, right? So you have to do things in the right order in these processes. But the best thing about this one that Jarvis loved is we threw him a curveball midway through SBR. And I will say that Jarvis and Business Reset have always had a very commercial view of a surprise client claim and how we attack that and not get too overwhelmed by it. So, Jarvis, I'll let you talk you through
glad
how you
to
navigated that.
nice you made that sound anything other than just trying to deal with the massive pile of mess that it became. So look, luckily we got good lawyers. So yeah, so all looks pretty straightforward. ATO, bit of director super, and they might have had some loans there that they brought to account historical wages where they'd be taking drawings with the former accountant who didn't tell them actually that's not your wages. They've discovered they might have put some wages through, which means there's a bit of tax, a bit of super. It can all go into the SBR. And they must have got a COVID loan there because it's unsecured there with Westpac, which is rare. So that was 220. And then, part way through, this client, and clients are the best, came out and said, oh, no, you owe me 411 grand. Now, they obviously hadn't gone to the home warranty insurance, or they had and were successful, but that didn't stop them having another shot. Every lawyer says you've got the best claim. So they lobbed their claim in. Naturally, it was disputed. And I think this was the second one. So you gave us another one, which is an even bigger mess, which was disputed at least beforehand. So we knew what we were getting into and had a practice run there. We knew what to do, which was really to work. You've got to make a just estimate. You've got to go, look, I'm not a building assessor. I'm not going into all the detail. I've just got to make an assessment there about, well, where are we going to land where both parties are happy enough? And naturally, the builder didn't want this guy to get a cent. On the other hand, if it didn't get wrapped up in here, there's legal action, the SBR would fall over. That's it. Like, there's no other option if he doesn't get the SBR up. So pulled his head in, came to a commercial deal, and we got it through, saved him 618 grand. And so he paid 197 up front. And then just to get that rate of return up, he paid 60 grand over 12 months, which is probably halfway through. So good outcome, saved the money, dealt with that claim, right, which could come about at any time. And similar to the other one, I mean, on the other one, it's, bigger numbers and the lawyers just going hell for leather at each other, despite the poor client just getting stuck. They've even gone at each other after the SBR. So now there's a case with my name in it and your client. So the beauty of this is you can wrap up those issues so that you've got a line in the sand, clean slate, certainty moving forward, which is what you need, right? You don't want years of litigation. Okay, move on.
All right, next one.
Yeah, this one's probably a clean one, wasn't it, Jarvis? And this one was actually most recently voted in favour by the creditors. Thank goodness. It was really good outcome. But this is an example of maybe the old company, even though it gets a debt reduction, maybe for a number of reasons, including licensing, it just can't quite tick the boxes post SBR. So this is that real sort of reset button, fresh opportunity, but still being able to use SBR as a bit of a tool to sort of make sure that the future, and this was a good 8 months for this client before they actually pulled the trigger on SBR to get things in a row. So James.
No, that's right. Yeah, with your licensing laws, even if the company's delicensed, I mean, particularly in Queensland, it's a 2-year window. It can't go into liquidation, otherwise the directors lose the license, right? So you can use an SBR on a company that's not trading. Makes me a bit nervous because where you restructure to a new company, it falls into that realm that's kind of called phoenixing, but it's completely legal if it's all done fairly, done right. You guys obviously did that. No problem with it. We put it in front of the ATO, gets the green light, right? So ATO was 170. These guys had some trade suppliers in there. I guess they couldn't pay everyone, or maybe they weren't working with those and they just had to do the right thing. As much as people want to pay their debts, you don't want to commit so hard, particularly with a new company, that you actually sink the new company, right? You need to give the business the best chance of survival. So these guys pay the 10 grand up front, and then they're going to contribute 94 grand. I think it's not yet fully done, but they've got to pay in one go. And that is appealing, particularly if you're in New South Wales or Victoria, because you can't reapply for your home warranty insurance until you've paid it out. The good news is how the process works. once we have the money, we can pay it out, be finalised within a week, and we update the credit report, or we give you the link there to update the credit report so that everything's done behind you. Your ASIC record updates after 9 weeks, and the credit report after the things all finalised. So good outcome.
That's interesting. That's a key point, isn't it? You know, so for that home warranty frame, as well as the credit report piece, that whilst those repayments are happening, that you know, you're still not in a great position. Better that obviously you've had that massive debt reduction, but there are those other knock-on things to consider. And so in this situation, because it's almost all paid up front, you know, they're back and away. Now, I think this was another Queensland one, so the home warranty piece wasn't as relevant, but the credit report piece is. But just it's key for people to understand those different arrangements that are in
That's
place.
Right. So yeah, 9 weeks from start to end is the sort of standard process. You can maybe speed it up if you need to. It's just all about preparation and getting that money there, thinking about what you're going to do once it's accepted. So last one.
And that's what example 3 is about, because this was heavily a decision made for credit, actually, because of what they're doing. So just a high level on these guys, Resi Space again, they came to us a couple of years ago, and their advice from their previous advisor was, oh no, this company is pretty much a dead duck. You may as well shut it down, which wasn't particularly great advice. And we sort of jumped in probably a good year before Jarvis came in. And helped with some QCC stuff, etc. But started the planning process, and this was the key thing: is these guys wanted to really do their own property development as well, and so that was a big thing for us to think about as part of this strategy. So this one was one of the success ones where paying the SBR up front meant that they could then kick on. And I can tell you, even present day, they've actually got approval for funding from a bank as of now. And this SBR was done about 6 months ago, I think. And they're already kicking on, getting finance to do their own project. And we're now doing a QBCC MFR uplift because the building company looks bright. Its future looks lovely now. It was only possible because Java's stepping in and really helping us clean it up.
Yeah, I mean, all
three of these companies, all these three of these examples are all now still trading and doing really quite well. So, that's the intention of the option.
Yeah. No, look, we got over 200 successful SBRs behind us, and less than 5%. So I reckon probably 6 or 7 must have pulled the pin at some stage and said, no, it's not on. But everyone, largely, I mean, that's a very high success rate, right? Like that's higher than business usually.
Yeah, it's exceptional.
So no, look, I mean, the key is, right, is you got in early and you didn't go, oh, we need to reduce the debt. That's going to save the business. You got in, you got your CFO team working on the profitability. You made sure that, yes, this business is good. Another accountant looked at it and went, oh, no, shut down. It's just because they didn't know how to fix the profit and they don't know about insolvency or SBR. They don't want to talk about the options. So they go, oh, no, I don't know about it. Just close, go see a liquidator, Google them. And I feel like it's like you're like an insurance policy as an accountant, right? You are there, fine, you get your money every month or when you get paid in the good times. But when times get tough, like you can't smoke bomb on the client, like that's when they need you the most. And that's what you guys, I mean, I guess you pick up clients because that's the situation. And that's how people often come to me is they've got a loan account, they've got an ATO debt, and their old accountant just isn't talking to them. And so they Google me or they find you and then we can pull it together, right? And give them a great outcome. That's amazing. Like they literally say, you changed my life. Like, thank you. Like they didn't know that could be a possible opportunity. And, it feels weird when grown men are in tears on Teams to me. But I'm very privileged because I used to just be the janitor cleaning up old companies as liquidator. But to be able to offer this, like it's amazing turnaround. So all right, so 430, they had some director super in there as well, so 440 all up. And they were fortunate enough there to have the 122 that they could offer as an upfront installment. If you got an upfront, it means you could probably pay a little bit less to the ATO as well, because the ATO knows, if you thought someone owes you money, if they say, hey, take a 70% haircut and then I'll try and pay you over 2 years, or take 70% haircut and I'll give you the money as soon as you say yes, you can tell which one's going to be a little bit more appealing. So not everyone can do it, and it needs to suit your cash flow. We don't want you to commit to something that then causes knock-on cash flow problems, but there are some benefits in if you can make it work. The good news is this one, I think so. Yeah, it's all done and dusted and behind us, right? So it was very smooth sailing, right? Which is that's what we want, right? We want certainty.
Yeah, and as Josh said, back on the park, fighting a good game now. And really, it was a very good piece of legislation. Really, I mean, it was designed around the challenges that we had coming into COVID, to make sure that businesses who'd found themselves in a window of troubling times, that the underlying success of the business is evident. There's some data to suggest that it's actually performing okay. It's just dragging this debt into the future, which is very challenging, obviously, financially, but also the mental health piece around that as well.
Yeah, huge.
So it is, as Jarvis said, it's a really nice kind of part of the work that we're able to do to be able to, set people free from what is quite a very challenging situation, and allow them to really, get back into things in much better shape. And we do it very carefully in the industry. We need to really make sure that all parts of supply chain are looked after. And by and large, it has been a story of ATO debt that has been the major problem, with other bits and pieces in there as well.
Yeah, ATO debt doubled for small business from 17 billion in 2019 to 34 billion in 23, and it kept going up. It was like 35.6 billion last year, right? So, as much as the pandemic's over, the tough times are still here, right? 100%.
Indeed, indeed. All right, now we're going to try and be true to time here. We're on 10:31, so we've pretty well done it. Just quickly, I'm going to put up this poll, which is to see if you guys want to talk about this privately on a call, then just answer to this poll here, which is yes, I'd like a consult to find out more. Now that can be about SBR, it could be about the CFO advisory thing, whatever you want to talk about from an Xact perspective. But if you wanted to talk to Business Reset, you can do that as well. So just get in touch with us. No one outside of us will see these responses, so you don't need to worry about this being a public putting your hand up exercise. No one really wants to share that publicly, but if you are interested in having a further discussion about this, then get in touch. Just quickly, our next full webinar, it's a masterclass. This is our property development for builders. Well, builders, anyone who's in the industry, I guess, and has the capacity to do their own developments. We're joined by the NAB. Julie and Gus are going to join us. They've got some quite interesting approach to building and construction at the moment. They're in the game. They really want to get in and support the construction industry, and have got some very interesting options in that space. They also, though, obviously being one of the big four, they've got certain criteria that people need to meet for them to lend. So they'll be taking us through that as well. But it's quite a compelling option, I think, for builders to be able to start their own developments and start to enjoy some of that margin that developers get, and to not have to have all your eggs in the client basket. So we're going to talk through that one just after the Easter Anzac Day break, is when that one's kicking off. All right. There was one question in there, which was, does the total debt include the interest, Jarvis? That was one question, and the simple answer is it's all
so
in.
I'll just I assume that's what's included in the SBR, right? And people wonder, oh, do I have to wait till the end of the quarter? The thing is, the ATO will issue a final BAS at the SBR start date. So if you started today, we'd get a BAS from 1 to 7 April, and it would every cent of BAS debt's included.
Yeah, and as part of the process, we'll do a final set of accounts, and then that's how that's what the consideration is from a ATO perspective. So, all right, that was the only question. Happy to take any more questions here if anyone has them. But otherwise, Jarvis, thank you for coming on today, mate, for our first mini. Very important topic. We might bring you back on in 6 months' time and see how we're going.
You might want to see me again, but your clients definitely don't. Okay, so one time only.
But yeah, many thanks for joining us today, Jarvis. Josh, thanks as always, mate. Very good insights there. Thanks everyone for coming along, and we'll see you at our next one. If you need anything in the meantime, get in touch. We'll talk to you soon.
Cheers, guys.
Lovely. Thanks, everyone. Thanks, Javez.
See you guys. Bye.